Everybody, Josh Sigurdson, World Alternative Media here, and we are joined once again by Lior Gantz of Wealth Research Group, and I'm very happy to be joined by you again. So first of all, thank you for joining us.
Hey, thanks, Josh. Thanks for having me back.
Absolutely. So I wanted to talk a bit today about the gold and silver markets. We've seen a lot of upwards trajectory in the last few months. We've seen major bounces 2015 or 2016 and then 2018, and we're seeing it again this year. We're seeing major gains. A lot of people are looking at the gold-silver ratio as a potentially signatory of a major boom and potential huge bust in the monetary system and the stock market. First, I want to go into gold. Where do you see gold going in 2019? Because there's a lot of telltale signs of a potential bull market on the near horizon.
Well, first of all, I think it's important to look at the big picture for gold. So gold is trading at all-time highs at about 74 different currencies. So the fact that it's not trading in an all-time high in the US dollar is a testament to what has transpired in 2018. In 2018, the dollar was the best performing asset in the world. So in other words, in the 1st of January 2018, if all the hedge funds would have closed their doors and taken a sabbatical, it would have been better off for them and their clients because holding cash was actually the best performing asset to own. 93% of asset classes were down in 2018. Very different than what we're seeing right now in 2019. Now, so for one thing, it's important to understand that when you trade gold, you can really leverage the international exposure of it. One thing that I've done over the years is I've turned US dollar fiat into gold and then converted it into weaker currencies in order to buy international real estate. So basically, you leverage the power of the dollar during the monetary stimulus, and you leverage the power of gold versus these other currencies, including the euro, and then you can go ahead and buy real estate depreciated in other currencies, and obviously get a lot of diversification geographically. Now, to more of an answer your point about this, so the most determining aspect of where the price of gold will go in the near term is the trade deal. In 2018, the dollar was the best performing asset in the world because there was no trade deal. So when you don't have a trade deal, China's appetite for dollars is increased. They have to own dollars in order to create a balance for their trade deficit or their trade surplus with the U.S. Once there's a trade deal in place, the need to hold U.S. dollars for the Chinese, who are the biggest holders of treasuries, is diminished. So, Trump has gone on last week and he said, I hate the Fed. They create a situation where the dollar is artificially strong, but actually it's not only the Fed, it's unintendedly, that's what he's doing himself with creating a trade war. So once the trade war is locked and you create a deal with other countries, especially with China, the need to hold dollars is diminished. And that's when you can see gold really erupt. So you saw a rally 2, 3, 4 weeks ago, you saw gold going to 1340s, right? And the idea behind it was that there was optimism regarding a trade deal. Now, last week, that optimism got subdued when they said, look, it's going to be delayed and we don't have, and gold sold off to 1286. It bounced on Friday, Friday the 7th or the 8th, I'm sorry, as we saw on a very weak jobs growth. So what I liked about it was that it really popped immediately on weak job growth, and that means there's a bid for gold. Now, what's very interesting is that there is no bid for silver. The 85-to-1 ratio is very rare. We've only seen it 3 times since the early 90s, and every time that has happened, silver has found a way to close the gap to gold to around 56 or 60-to-1, and that's what I expect this time. So if you're looking to trade either, silver right now is a much better trade in the short term. With regards to where I see gold going, it should, if there's a trade deal, it should break its 52-week high of 1362 intraday from 2018, from April 2018. And for silver, it could go over $20 this year. Now,
Mm.
what I like about silver is that when silver starts to rally, the gold and silver mining shares also start to rally with it. If you remember, 2016 was an incredible year. For example, for Wealth Research Group, we profiled 12 companies that all doubled or more. And there was a rally. It wasn't a bull market. So the bull market in gold and silver has not begun. They're trending higher and they're moderately higher, but definitely this is not a bull market, a strong bull market in precious metals like we saw between 2009 and 2011 or the early 2000s. Trade deal is the most determining factor. Look at that and the correlation if you want to look at the price of gold. And ultimately, our target for the end of the bull market is about 1704 for gold.
Well, and I'd like to make the point that I've always looked at gold and silver historically as wealth insurance more than even an investment, though obviously you can invest in it. Obviously, those of us who talked about buying gold and silver in 2007, our viewers, are the people that follow us, like us a lot. Those of us that talked in 2012 about buying gold and silver, not so much. But with that said, you got to look at the long-term market and see those that have gotten involved in the market manipulation of gold and silver over the years. Lots of spoofing. I mean, fundamentally, gold and silver should be a lot higher today than they are. There's been a lot of factors that play into it. A lot of banks, JP Morgan, Deutsche Bank, you name it, spoofing the markets, Scotiabank, etc. Probably most major banks have gotten involved in spoofing the gold and silver markets, and many of them have been caught red-handed. And I find this to be a major issue coming up when people message me or comment on our videos regarding gold and silver. They say, oh, well, you've been saying this for years. Why aren't we rich yet? I lost, 5% or something in silver, or something along those lines. We've all heard it. What do you say to people who, express these concerns despite a very seemingly artificial market in a lot of ways?
Yeah, so if you go to wealthresearchgroup.com/dead, DEAD, like dead, gone, you'll see part of the problems for the dollar going forward. Now, and if you go to wealthresearchgroup.com/enemy, you'll see the feud between Trump and Jerome Powell and how this will play out in terms of the dollar. It's important to understand in the long term, gold and silver are wealth preservers. That's all they are. Nobody's ever gone broke holding gold and silver. You mitigate risk by holding them. Now, what is the risk of holding gold and silver? The risk of holding gold and silver is to overpay for either of them. And then you might hold them for a very long extended time, not going broke, obviously, but with diminished returns. So the first thing, and I wrote about this at wealthresearchgroup.com/bear with my 11 bear market strategies for holding gold and silver. The first thing to do is to hold a proper position size, Josh. So if you have 100% involved in gold and silver, like some of these people that I hear sometimes on YouTube, suggest, that's as toxic as holding no gold. You never need to fall in love with any asset class as to hold 100% in it. Personally, what I did is took 24 months of living expenses and I converted them from fiat to gold and silver. 80% gold, 20% silver. So, for example, if my burn rate every month is about $5,000, so I took $120,000. If it's $10,000, then $240,000 and converted it. And then I bought it through bullion dealers and I allocated it in 4 continents. So I have some in North America, some in Europe, and some in Asia, and in other parts of Asia as well. So in 4 vaults around the world. I have some with me, but not a whole lot. And that's my wealth preservation position. 2 years worth, because if there's a recession, a huge recession, and things get bad, you have 24 months worth of living expenses that are converted into precious metals, and they're not only in one place and they're not only in one jurisdiction, etc. Obviously, it's important to form good relationships with the dealers. So when push comes to shove, you'll definitely get your metals, and that's one thing. Now, if you want to speculate on top of that, then you can look at your net worth and say, I want something like 7% or 5% or 10% of my net worth to be in precious metals, physical precious metals, and that's another matter. So that's another way to look at it. But you should not look at gold or silver as mechanisms to become wealthy. The way you get wealthy with gold and silver ultimately is if all else fails. And that doesn't happen very often. These are very long cycles in which people that hold gold and silver, exploit a currency crisis or debt crisis or hyperinflation in a country. And it doesn't have to necessarily be the U.S. But what I want you to look at in the long term is where the price of gold was in 1971 and where it is today. Same with silver. And then I want you to look at the production price. So if you buy silver at $40 an ounce, where the price of production is $15, you're making a mistake. There is no need to buy either when there's a speculative mania or a bubble or mini bubble in their prices. Now, where should the price of gold and silver be? Which is the most important question, right? The best way to look at it is through the coverage ratio. And I wrote, if you go to wealthresearch.com/Fed, there's a whole thesis over it. But the best way is to look at our 80-to-1 special report, which is at wealthresearch.com/ratio. And there I put out everything regarding where the price of gold and silver should be. And it all talks about the coverage ratio, Josh. So how much of the currency is covered by gold and silver? In 1980, for a brief few weeks, 100% of the currency supply was backed by gold. So if we were to go back to a gold standard in 1980, it would have been possible at $850 per ounce of gold and about $50 per ounce of silver. So where are we today? About 6.8% of the currency supply in the U.S. is covered with gold and silver. So if you look at the classical gold standard of 20%, that implies a price that is 3 times higher than today. So if you're looking at 1,300 times 3, that's 3,900. So we're definitely undervalued with regards to a classical gold standard. Now, the double classical, the 40%, that's 6 times today's money, and that's 7,800 for an ounce of gold. Now, what does that mean? It's not a vacuum. It's not trading in a vacuum. So if the price of gold were to go to 3,900, that would mean a lot of things for a lot of other asset classes as well. This type of scenario would happen in a dollar devaluation phase, and it will also happen in a commodity super cycle. So there's a few things that can create it. What I think is likely, because of demographics in the U.S., because of the election cycle in the U.S., and because of the deficit spending in the U.S., and because of the rise in China, is you're going to see a lot of demand coming from China, just pure demand for gold, physical gold, which is obviously the most pressing thing. The supply of gold is interesting, right? Because we are seeing peak gold. We're seeing that the supply will half. The mine supply will half from here to 2024. But Josh, all of the gold that has ever been mined is above ground. So demand is usually what creates the price. How much are people willing to pay for an ounce of gold is more determined than the supply of it. Not so much with silver, which is really a quasi-industrial metal, and that has a lot of issues with supply.
Yeah, there's a lot of scarcity with gold, and obviously people have to look at gold as protection of purchasing power more than an investment, like we mentioned, unless you, of course, put $10 million into gold in 2002 and cashed out in 2012. But nonetheless, it's usually about protecting your purchasing power. And I'm watching, I want to go into China in a moment, but first I'm watching the stock markets, and something strange is happening because look, we saw a major bust last year for most of the year, and then we're seeing somewhat of a rally this year, starting off the year. And I don't really have a lot of faith in it overall. I think we're seeing a lot of factors play into this, but I have a really hard time believing that such a bubbled stock market with so many non-valuable, fundamentally useless, investments on Wall Street. I have a hard time believing that it's going to take off to the moon and hit new highs anytime soon. How long until the stock market rally ends, in your opinion?
So this current rally, the January-February rally, is the strongest since 1987. And if March continues the way it is, it's going to be the best start of the first Q1 since 1956. So we are in a very big rally, but we aren't overbought at all. That's the big thing here. There's outflows from all the hedge funds and from all the mutual funds. So whoever's buying is buying in low volume. The retail investor is still freaked out by December. So while most people think that, hey, this is going to crash big, it might not. And here's a few reasons why. And again, the S&P 500, the Dow Jones, the Nasdaq, they're all baskets. They're all indices. So the S&P 500 holds 505 companies in it right now. And some of them are incredibly overvalued. Some of them are undervalued. And then in the end, it's a mix of the 505 most robust companies in the world, right? So, or in the U.S., I should say, but most of them are multinational. And when you buy the basket, the S&P 500 is a basket. You're buying some overvalued stocks. You're buying some bad stocks. You're buying some very good stocks.
Mm-hmm.
If you're a stock picker, it's altogether different, and you live in a different realm because you look for fundamental companies that you like and for prices that you like. So while the stock market itself, the basket of companies is advancing, and there's a lot of expensive companies in there. There are many companies, or not, I shouldn't say many. There are about 10 companies right now in the S&P 500 that are trading at bargain prices or they're good prices, and they're good investments at the moment.
This sounds kind of like collateralized debt obligations almost.
Well, here's the thing. All stocks, all companies, they go through phases where the market discounts them for good reasons and bad reasons. So if you look at about in 2012, for example, or 2011, there was a hype called the end of PC. People thought that's it. There's all people will switch to tablets, and Intel, which manufactures about 80% of the chips for computers, they were discounted and marked off. They were almost trading at at bankruptcy levels. And I bought a position. It was trading at $22 per share. Now it's 52 today. And that was a clear case of misjudgment by the market. So it was a fixable problem and a overhype in one example. There are examples of obsolete businesses like newspapers, for example, where it doesn't matter what the price is because it's going to go down. It doesn't matter if it's trading for liquidation cost, which basically is the price to replace all of the equipment. There's no premium because it can still go lower. It could trade for a negative premium. And so what you need to look for is companies that have what it takes to continue growing, but they're going through this phase that the market is mispricing them for any sort of reason. For the entire market, Josh, the market is not mispricing it at all in terms of negatively. It's overhyping the entire U.S. economy. And the reason it's doing that is because everyone is sure that the Federal Reserve will come in again and stimulate again and cut interest rates again. And that will create a situation where stocks are going to see a lot of more dollars going into them, and it's going to be higher.
Well, that's one of the things that I'm kind of wondering about is how much money is being plunged, so to say, from the plunge protection team by the Federal Reserve into the stock market.
But it's definitely the fair price for the market is definitely not what it is right now. So we aren't living in a situation where the markets deserve the P/E ratios that they're getting right now. But as an investor, we don't deal in should and shouldn'ts. We just deal with realities. And the market is rallying for the past 2.5 months because one, there's a lot of optimism regarding the trade deal, and that fuels a lot of optimism in the stock market. Which is one thing. And then you had the Fed reversal. Basically, the Fed saying, hey, we're going to probably stop hiking interest rates, which is what caused the December mini bear market. And they said we're open to what we call perpetual QE. So, Josh, nobody's talking about this, but they basically just issued an essay saying that, hey, QE is not an emergency measure anymore. This is probably going to be a tool for us. So a tool means we're going to keep buying bonds. We're going to keep buying any distressed asset that we like as a matter of policy and not as a matter of emergency anymore. And I think the reason they're doing it is because they want the next time that there will be an emergency to say, no, this QE program is part of our procedure right now. This is not an emergency. You can relax and keep buying the markets. So they're doing a lot of shady stuff that I don't like. And they even issued an essay about negative interest rates and how effective they were in creating the recovery.
Yeah, helped them a lot in Sweden. I mean, this is the issue, like you mentioned QE and it not being an emergency measure anymore. I mean, that goes back to even the Keynesian economics itself was once considered a wartime, exercise in order to combat against, wartime monetary issues back in the 1930s, 1940s. So, I mean, it always seems like it's almost an incremental frog boil to normalize a lot of these tactics, and that's what kind of concerns me about a lot of this, is that they seem to be almost in desperation mode. And that actually brings me to my next point when it comes to China, because it appears like there's a huge shift, working its way towards China with them, hoarding a bunch of gold and a bunch of silver, them unrolling this absolutely crazy looking cashless society with social credits and facial recognition. And it's concerning. It's like something out of a Black Mirror episode at this point, or something out of an Orwell book. And it's getting concerning to a lot of people because it's beyond fiction at this point. China is really moving towards being the next major world superpower, and there's many countries that are siding with China on this, and many countries that are swapping out of the US dollar. So, I mean, where do you see China going in the near future? Could it be number one down the line?
So the global GDP is made up of about 25% the U.S. So a quarter of the world's economy is dependent on the U.S. And by the way, Josh, 70%, 17 out of that 25 is the U.S. consumer. So the world, a sixth of the world's economic activity is people going to Walmart and shopping. So that's why they're either a recovery or a recession is dependent a lot about the U.S. consumer and what it does. And that's why you see a little bit of the market rallying, because the U.S. consumer right now is receiving about a 3% wages hike in the past 2 years and every year, which is a lot for the middle class in America, which has seen nothing for about 20 years here. And now you got these socialistic politicians raising minimum wage in about 20 states. And it's going to continue because a lot of people feel like they've been left out of the recovery, and they don't even see that where was the recovery. It could have been in another neighborhood, but not for me. And so because there's so many Americans like that, about half of the workforce in America, so the American workforce is about 150 million people. The Chinese workforce is about 750 million people. And half of the American workforce, 75 million, are working for about 30K a year before taxes. So there is no middle class economy anymore. And then 15 million out of them are on minimum wages. So 10% of the economy is minimum wages. In Canada, it's even more. And so what you're seeing with regards to your question, a quarter of the world's economy is the US, and about 15% right now is the Chinese economy. So put together, they're about 40% of the world's economy. And that's why whatever they do is very, very important to the rest of the planet. And with China, their growth rate is about 6%, and the U.S. growth rate is about between 2 and 2.5%. So at this rate, in about 7 to 8 years, China will be probably at par with the U.S. in terms of GDP. And between now and about 2030, they'll have a larger military. So they're definitely going to become a superpower. Now, people don't talk about this, but India will probably surpass the U.S. by 2030 as well. So there's a lot of changes happening. The U.S. is losing the empire status of it. It's probably going to lose the reserve currency role because there will be no reason for 1.5 billion Chinese and about 1.5 billion Indians, which make up about nearly half of the world's people, or 40% of the world's people, to trade internationally using a U.S. currency. but it's a transition. So that's what a lot of the gold people and silver people need to understand. 60% of the world's currency is dollars. You can't just phase it out that quickly. Only 1.5% of the world's currency is the renminbi, the yuan, Chinese currency. 20% of the world's currency is the euro. So between those two Anglo-Saxon superpowers, Europe and the United States, that's 80% of the circulation of the world's currency. So you can't just eliminate 80 years or 100 years of dominance by the West that easily. But there is a transition here for sure. What people that know their history know is that China was the world's largest economy and a huge dynasty in the 1300s, much bigger than anything else. And they became the poorest country in the world by building a wall and shutting themselves off to trade with other countries, etc.
Yeah.
So this is a transition. It's not immediate, and that's why you shouldn't wake up every morning thinking that tomorrow is going to be the last day, right? So just and this is something I implement with my own portfolio. 75% of it is invested in cash flow. It's invested in the world keeping on growing. 2% is not a recession. So when you grow at 2%, you're not at a recession. That's what a lot of the contrarians need to understand. With regards to when the U.S. can roll into a recession, it's usually when the unemployment rate spikes higher. It doesn't matter what the starting point is. So I know that the job market is very tight right now, 3.9%, a lot of participation. In fact, the highest participation for Hispanics and for African Americans in U.S. history. But still, it doesn't matter. It doesn't matter if it goes from 8 to 8.5% unemployment or from 3.9 to 4.1. The trend shifting is what creates the snowball where companies and corporations start to fire people, and that rolls into a recession because CEOs are starting to conserve cash. They don't buy back shares anymore, so you got capital gains tax going down. People, it's all snowball. It's cycle. It's all it is. And instead of trying to predict when the cycle begins or when it ends, what you're better off doing is try to think of it like I'm thinking of it. Take 24 months. Put them in gold and silver forever, or take 5% and put in gold and silver and increase it as your life progresses or as your net worth increases. But put most of your money into cash flow. Find cash flow assets, real estate, stocks, etc. But if you become an expert on it, it can work for you. If you go to wealthresearchgroup.com/dividend, for example, or to our websites at the top menu, you'll see Dividend Mania button. Look at it, read it, research that. Understand that is a big part of succeeding in the long term. Now, with regards to risks, that expertise will help you to understand when you need to cash out, when you need to become more allocated in cash. But just in general, China is definitely going to become a more important figure. As you saw it at the end of World War II, where all countries voted the way that the U.S. did in the UN. And they're just their term dragged countries because they're dragged after the U.S. Or after the U.S. bloc, whereas there was the USSR bloc. So now there's the China bloc and the U.S. bloc, and with the One World, One Belt initiative, more countries are going to flock into China because China is willing to lend countries money 20 years into the future, interest-free. When you're an African country or a Eurasian country, and they tell you, hey, we'll bring the workers, we'll bring the asphalt, we'll build the roads, we'll build the infrastructure, you'll pay us in 20 years. Well, can you tell me a prime minister that is going to say no to that? So
well, I mean, we're already seeing China do a lot of the things that the IMF has done for years, which is basically loan more money to countries, especially in Africa, than they can afford to pay back, essentially getting ownership over their grid and over their infrastructure. So that's definitely a major issue going forward. But I have to acknowledge something that you mentioned about the transition, which is that, I mean, going back to the 1970s, the establishment establishing the Trilateral Commission and this becoming allies with China to a certain extent, we've seen the growth of China astronomically since the 1970s. It's just grown enormously, and it's hard to not see a correlation between a lot of the efforts by the Trilateral Commission to create a technocratic state as they put in their blueprints. Brzezinski talked a lot about that, wrote a book about it. It's hard to not notice the correlation between that and what's happening today in China. And obviously on top of that, with China and India having some issues between each other, two of the most populated countries in the world, they're kind of having a lot of disputes with each other at the border over the last couple of years. And it makes a lot of people concerned. You see, for example, the U.S. empire potentially getting replaced by the Chinese empire, or the Indian empire. Personally, I don't want any empires, but all the same, it's something that's going to become a reality going forward. And it goes to show something that you kind of noted earlier, which is that, the markets, capitalism, they grow wealth, they grow prosperity, if you're responsible, of course. And then the government stifles wealth and prosperity and growth long term, as we're seeing with the minimum wage hikes in places like Seattle and elsewhere, where it's really starting to hurt a lot of people. Businesses are moving out of these cities, and we're seeing a lot of malls close, a lot of major retailers close, at the same time as we're seeing a very bullish market for the beginning of the year. So I'm confused as anyone else right now. I don't know what's going to happen next, but I always really appreciate your reports and Wealth Research Group's reports on these subjects, because they clear a lot of the air when it comes to a lot of these concerns that a lot of people have going forward. So as we close it off, I just wanted what's your biggest piece of, I wouldn't say advice for legal reasons, but what do you think is the best thing for people to do, people who are watching right now, going through 2019 into 2020?
So before I answer that, I just want to touch on something that you just said, because it's very important. With regards to minimum wage and all of government intervention, it creates unintended consequences. So if you don't have a minimum wage, if you let the market figure out what the minimum wage is, then a lot of people that are on the wayside would have been employed. There's a lot of businesses that would have employed people had it not been for minimum wage. And a lot of people would have agreed to get paid less than minimum wage because of their position in life right now. So minimum wage, all of it, all of these prices and mechanisms, if we allow the government to come in and intervene with them, they distort things. Like you said, they can distort companies going out of Seattle, for example, to other cities, etc. And it's happening throughout the U.S. and around the world. Now, what is the end of this? So it's either going to be us, the free market, entrepreneurs, people on YouTube, people everywhere, the business leaders that shape up the future to be more inclusive, because it's not inclusive right now. High-end and top-level CEOs, they make insane bonuses. Mid-level employees, they save, but they have a hard time to retire. And low-level employees, they're just gonna work until they expire. They're not going to retire ever. And so either we find a way to create a more inclusive capitalism, or the government will come in, which is what's happening right now, and enforce this upon us. And that's the rise of populism. So it's either going to be this or this. So you can expect, if you don't see any improvement from business leaders, you can expect political leaders, I don't want to call them leaders, but political figures to come in and try to correct the situation with laws and regulations, etc.
And we're seeing that with the rise of people like AOC and others in the United States. And this is a major... Yeah, and it's a major issue going forward if you consider the fact that on the free market, companies compete for the best price of the best product, and that means more production, more money, lower prices, more employees, etc. And then the government comes in and creates major monopolies, cuts the competition out of the markets, raises taxes, regulations, all that, and then we have more problems, more unemployment, and it hurts everyone more. So people would technically be making more money versus also the price of living if the market was freed and we didn't have this issue with inflation, etc. So it's really important to understand this issue because people get really reactive and emotional over the issue and think with their emotions before they think with their logic, because it sounds better to say free stuff and, you know, be fair to everyone, but it's really not fair to everyone, and it creates so many problems down the line.
When you raise minimum wages, you give CEOs an incentive to either fire or move to automation. So it's not as simple as people think. But you know, if you're looking at 2019 in general, if there's a trade deal, the markets are going to rally hard. When they rally hard, you have a choice. You can participate in it as a trader, as a short-term investor, or you can just let it go. It doesn't. The market's rallying doesn't mean that you need to be a part of it. I haven't bought the S&P 500 in about 3 years, the index, but I've bought many stocks not many, but I've bought a number of stocks into interim because they were specifically attractive and undervalued. And that's what we cover in the Wealth Research Group newsletter, the free newsletter, because that is our focus, finding investment opportunities in any case. And that's, you know, we're not Warren Buffett. We don't have 120 billion that we need to put in place, and he's having a hard time doing it. We're individuals. We need to focus on cash flow in the markets and outside of the markets in other regions, and that's what I want. That's my primary message. Focus on education and on financial education, and focus on your main career, because those are the two things that will really help you escape all these shackles. The rest is just put upon you by society and by you know, whoever came up with this term positive inflation. It's just bullshit. How can you have positive inflation? There's the only thing that inflation is negative. The best time in U.S. history was between 1875 and 1900, when there was huge innovation, huge entrepreneurship, a lot of philanthropy because there was no income tax, and people decided what to do with their own money, especially the rich. And then you had deflation. Deflation. Prices just became more and more affordable because of competition, because of innovation. And that's what would have happened from the 1990s until today, had it not been for loaning our way into GDP growth, because the internet has brought so much innovation. There should have been price deflation in almost every price and goods of services, especially with the globalized world, but it's not. And the reason is they borrow and they borrow and they borrow, and they just create more deficit spending. And right now the jig is going to be up with $1 trillion and $1.1 trillion annual deficits, and with nobody needing a hoard of dollars anymore. That's going to be detrimental for the U.S. dollar for the next 5 to 7 years. Again, not tomorrow morning, not hyperinflation Zimbabwe style, because 60% of the world's currency is dollars, but a 20 to 25% reduction in purchasing power in the next 5 to 7 years is definitely in the cards. And that's a lot.
Yeah, and of course Zimbabwe based their most recent currency on the U.S. dollar and a basket of others, and now there's a second highest inflated in the world again. So that's more interesting news and more evidence of what we've been talking about for so long. But of course, who would have thought people spending money into the economy because they have more money in their pockets, that's a good thing, and people's money being stolen and put into inefficient programs that they don't actually support themselves, not so good. So, I mean, that's a pretty obvious lesson for us to all learn. And the more people learn that, the more responsible people are, and the more independent people are, rather than dependent on the debt that is holding them back. That's very important going forward. So I really appreciate all the work you do, Lior. As we close it off, can you tell everyone where to go and find more of your work?
The best way to find our top priority ideas and our highest quality information is in the newsletter. If you go to the Wealth Research Group site, you'll find the subscription form right there and the homepage. And if you want to increase your financial education, you can look at the top menu where it says special reports, and there's a wealth library of PDF reports, all of them accessible, and you can really learn a lot about what I've learned in the last 16 years, because that's what this library is all about.
Well, I really appreciate you joining us again, and we'll be making sure to talk to you again soon. And thank you very much. And this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
Thank you, sir.
Like what you see here, OM? Don't forget to check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so heavily demonetized and censored by YouTube as these guys come in and flag all of our content as hate speech. The shadow banning is getting really bad, guys. Also, check our Bitcoin address right here on the screen or in the description below. We really appreciate it. And of course, check us out at the Red Pill Expo 2019. Of course, the great G. Edward Griffin and so many other incredible speakers will be there. Our link for that is below as well. And we cannot forget Mike Maloney's goldsilver.com, which you can also find in the description. One of the greatest market and monetary historians out there. We really encourage everyone to check that out. But until next time, this is Josh Sigurdson signing out from World Alternative Media. Find the truth, be the change.
I'm sure you have already changed people's minds in your young age because you're involved, and I like that.